Oh, hi everyone, it's Susie here from Esoteric Trading Solutions. I hope you're all well. I hope you're all being kind to yourself, being kind to your family and friends, being kind to your animals, your dogs, your pussycats, whatever animal you've got, and just being kind to people in the world to make this a kinder and friendlier place. I'd like to wish everyone a Merry Christmas as well. Have a great Christmas. I'm in Australia, so I've already had mine. I've had lots of prawns and lots of plum pudding. Very, very full, and I had a lovely day. But please enjoy your Christmas. Just like to give you an overview of what we've got in terms of our project for Kickstarter. Obviously, the modules that we're working on. This gives you a bit more information about how it's going to be and what's in it, and test your knowledge, practical exercises, and that sort of thing. So I hope you enjoy it, and it would be great if you could make a contribution to our crowdfunding. It's only got about 5 days to go, or 4 days. Closes on the 30th of December. It's tight for people in terms of money and that sort of thing, because people would have been spending a lot of money on Christmas and food and everything else, but it certainly would be a course where the money would be well spent. As I said before, it's €45, which is about $60 US. And there is a lot of information, a lot of references, a lot of links, and there is a lot of really good information there. So it'd be great if you could actually support it. Thank you. Wow, this has done this amazing thing with this presentation. You can tell that I haven't done it, that's for sure. What we want to talk about, obviously, is the cryptocurrency course that we're running. And this is just a sneak preview, and it's about crypto derivatives. So there's going to be a lot more information coming crypto derivatives, and a lot more examples and practical exercises within the course. It's going to be the best €45 or $50 that you've ever spent. As you can tell, I definitely haven't done the slides. Liz has done the slides. She's the rocket scientist. I'm certainly not that. I'm hopeless with this sort of thing. But anyway, it's going to give you an overview of what we're going to be talking about in terms of crypto derivatives. So basically, we're going to talk about existing products in the pipeline, retail investor products, how they work, pros and cons of crypto derivatives, the players and the regulators, how will crypto derivatives affect the value of the utility coins, references, digging deeper, test your knowledge. There'll be lots of practical exercises to test your knowledge, and a glossary of terms as well. Also, going forward, there'll be things like learning goals, basically speaking the lingo, understanding the common financial terminology, how it relates to crypto. Learn about different financial instruments such as CFDs, which are cash for difference contracts. I don't think you have those in America, but we have them in Australia and the UK. Futures contracts. Now, some futures contracts are cash settlement. The New York Stock Exchange next year wants Bitcoin to be physical settlement. So I think that's going to make it very interesting. And other exchanges have cash settlement for Bitcoin futures and Ethereum futures. Excuse me. Improve your analytical skills. Expand your ability to evaluate how derivatives will affect crypto market stability and open the way for institutional investors. Make informed judgments, be current on the latest happenings in the regulatory sphere, and spread the word. Develop an educated opinion on the mid to long term developments in the cryptoverse. So going forward, oh wow, this is cool. Cryptocurrencies, and what we talk about when we're talking about crypto products and crypto derivatives, what are already available. Obviously, cryptocurrencies are already available. We can trade those straight away. They're not like spot trades like the foreign currency market, where basically, it's T plus, 2, or in the equities markets where it's T plus 2, trade a day, settlement within 2 days. Within crypto land, it's settlement straight away. So straight away settlement, You get the ownership if you're, buying off the physical exchanges, and you can store it to your Ledger Nano S and that sort of thing. The potential benefits from airdrops and hard forks, potential to earn dividends from POS coins, and potential to access crypto loans as well. Wow, this is cool, Liz. Cash for difference contracts. And again, cash for difference contracts, as I said, are available in the UK, and they're certainly available in Australia. And you can actually trade cryptocurrency on cash for difference contracts. You can buy and sell cryptocurrency. They are basically, you don't actually own the physical asset with cash for difference contracts. So pretty much they're speculative. They are for retail investors generally. You'll put up margin and there will be a deposit, and basically you'll essentially, buy and sell that generally on a speculative. You can use them for short, for hedging. There's no doubt about that against a physical portfolio. But the thing is, a cash for difference contract, depending on what platform you use, whether it be CMC or 500 plus, some of them will have a maturity date on them and some of them won't. Some of them will be continuity or continual contracts, and some will actually have a maturity date on them. So generally it is for much, obviously more experienced traders, because they're highly leveraged. And, when, if it goes against you, effectively, leverage works twice against you, because you're getting margined. And as the market goes against you, you've got to basically put more cash in to top up when you've got a position that actually goes against you. So, I do use cash for difference contracts. I trade CFDs quite a lot. But again, I would say for people that aren't used to trading and not used to leverage, please be careful trading these CFDs, because, certainly leverage, and when the market moves quickly against you, it can certainly go against you very quickly indeed. So other products that are available at the moment, and again, it depends on what exchange you're talking about, are futures products. Now, at the moment, as I said, they are cash settled generally, but going forward, the New York Stock Exchange is talking about Bitcoin physical delivery against the futures contract, which is probably going to make it a better idea, because a lot of futures contracts are physical delivery, where you've actually got to deliver the underlying, Bitcoin as such. Like you'd have to deliver the underlying wool or the underlying wheat. Okay, with the futures contract, it is a forward agreement on a standardized product, and generally there's no underlying ownership of the cryptocurrency. And at the moment, yes, it is cash settled, and generally with a futures contract, you do have to put up margin for the deposit for the futures itself, and you do have to put up money to trade futures in your trading account, because if you're actually short futures, i.e. you've sold futures and the market's going up against you, then you need to top up that futures account. Otherwise, you'll be closed out by the exchange. Now, each of the exchanges have different standardization, excuse me, for futures contracts, and you really need to look at the standardization or the what it says in terms of the futures contract for the condition of that futures contract. Really, really important, because in other markets, generally futures are standardized, but you'll find on the cryptocurrency exchanges, or where cryptocurrency is, the futures contract will be different. On the CBOE, Chicago Board Exchange, it'll be different compared to the Chicago Mutual Exchange, for example. Okay, and there's also another exchange in the UK where the futures contracts can be different again. There are XRP futures in the UK. There's Ethereum, Litecoin, BCH. But again, you need to check the documentation to the criteria and to the details of what the futures contract is, because generally in other markets, futures contracts are standardized. But in the cryptocurrency market, not all futures contracts are alike. So it's really important. Now, futures contracts, as you know, are generally for arbitrages or traders. And obviously, people use futures, particularly the professional market, because they can get a lot of position out very quickly in terms of volume. rather than having to try and deal on the retail exchanges for physical. Also with futures, again, they get issued by the exchange, and there's as many supply of futures as you like. Whereas the exchanges for physical crypto, there's only so much supply. So in the futures market, as many bought, Bitcoin, as many sold Bitcoin as you want, you can actually get. As long as you've got the money in the deposit and the margin deposit, you can trade as much as you like. The next one we're talking about is the derivative exchange traded funds, essentially. Now, obviously, it's a fund that will track crypto performance. Basically, it's an index fund. So someone like Vanguard, which is one of the largest index funds in the world, wants the ETF market to open up. And obviously, they want the SEC to say, hey, yes, you can actually do that. You can actually do exchange traded funds. Now, Vanguard has the largest index funds in the world, for whether it be equities, whether it be fixed interest and bonds, whether it be cash, and they obviously want to be able to set up an index fund for cryptocurrency. Okay, now this is a fund that you get access to where you'd obviously have units within the fund, and if the fund goes well, you'd get units or a return from the fund itself. But you wouldn't have underlying ownership of the individual assets within the fund, but you'd have a piece of the fund, if you know what I'm saying, where you'd get return from the fund itself, where you'd buy and sell units within the fund. Now, the SEC hasn't done or hasn't allowed this to happen yet, and we know that the two Winklevoss twins, Winklevoss, what do they call themselves, who head up Gemini, have gone to the SEC about 12 times re the ETFs, and the SEC has said no every time because obviously they're concerned about valuation, arbitrage, and custodian solutions. And again, the underlying cryptocurrency market is still not regulated, so it is a real concern for the SEC, the Security Exchange Commission. Generally, these things are suitable for high net worth individuals and institutions, but there are fund management costs attached to them, okay? So the Security Exchange Commission has not regulated exchange traded funds. Also, exchange traded funds can be traded on the stock market, where you trade the exchange traded fund like a stock. You buy it if you think it's going to go up, and you sell it if you think it's going to go down. So the SEC, Security Exchange Commission, is really, hasn't decided what they're going to do in terms of the regulation of the cryptocurrency market. And I think they've got to regulate that first, the cryptocurrency market, before they can actually regulate exchange traded funds. That's my honest belief. If we look at ETNs, wow, this is really cool, Liz. Exchange traded notes, they are debt-backed securities and a cross between an ETF and a bond. Now, you'd probably call these a hybrid. Generally, they're called a hybrid, where they have, commonality between debt-backed securities and an exchange traded fund. Okay, so, like a bond, but like an exchange traded fund. They are traded by XBT Provider and AB CoinShare Holdings, but again, because they are, they're a hybrid, there doesn't appear to be any ownership of the underlying. Now, I don't know whether these are regulated either, so it's going to be interesting to see if they are regulated. I couldn't believe these things would be regulated, particularly when the SEC, the Security Exchange Commission, hasn't regulated the ETF market. Okay, so the course, the Kickstarter course will go into a lot more detail about these and how these products are used and that sort of thing. But also there'll be, questions and answers and all that sort of thing as well. So if we go to the next one, what else have we got here? Something comes up here. Oh my God. Get ready to reinforce your understanding and think about how you would use these products. So this is a product knowledge quiz 1. And obviously, there'd be questions that, we'd ask you, and then you'd have to answer those questions to see if you really know, what's being said there. So, wow, pretty cool, huh? Okay, and there's another one here, non-deliverable forward. So These things are being offered by Goldman Sachs, and they're an over-the-counter contract to buy and sell a notional amount of crypto at a certain price in the future. So non-deliverable means the forward isn't delivered, and it means it's a forward price and it's an over-the-counter contract. So it would be the professional market, the institutional market. It's not traded through the exchanges, but traded through Goldman Sachs and the exchange through, individual documentation that would be set down by ISDA, the International Swap Agreement Association, and the party that actually wants to go into that contract. So the buyer the buyer receives or pays the difference between the agreed price and the spot price on the expiry date. So there's non-delivery of the crypto. So it's like a swap agreement. You could call it that almost, a forward swap agreement with Goldman Sachs, and it would be used for hedging an underlying portfolio. And because it's an over-the-counter contract, it'll be very large in terms of volume indeed. If we look at the swap market, and again, swaps are in other markets, in capital markets particularly. Swaps are actively used in debt markets, and money markets, and floating rate, floating rate funding and those sort of things. So the swap market is huge. The derivatives market globally is something like a $1.4 trillion market. It is huge. And, it does have a settlement problem as well. Settlement is generally T+2, but with the advent of cryptocurrency and obviously, companies like Ripple with the technology that can settle instantly, they can effectively fix a $1.4 trillion derivatives market. The swap market is a derivative, of course, and these price return swaps are going to be offered by Morgan Stanley, a contract between two parties to the swap. The proceeds of two financial instruments. Buyer pays an agreed amount, usually monthly, and receives the increase or decrease in the value of the underlying crypto. So it'll be actually, let's put it this way, it'll be actually indexed to the crypto market. It'll be a customized over-the-counter contract for institutions looking for long-term hedging or speculation. So again, we're talking about institutions that would do volume. And when I mean volume, I'm talking about, 10 million up, 10 million, 100 million, 50 million, 150 million, 200 million. We're talking about large institutions that want to get exposure to the cryptocurrency market. Okay, so we're talking about huge volumes that are done over the counter, which are customized contracts between Morgan Stanley and maybe a large fund manager like Fidelity or BlackRock or even Vanguard or someone else. Okay, so if we look at futures, and again, I mentioned this before, some futures contracts will require physical delivery, and I know the New York Exchange is talking about this. ICE futures backed require custodian solution, backed warehouse, settlement in cryptocurrency, not cash, which I think is very interesting. And it does allow for hedging across multiple exchanges. So apparently they'd be much more, onto any price manipulation on the spot exchanges. And apparently they're saying that there would be no currency risk going forward, which I think is going to be quite interesting in itself. Other derivative is options. And again, all these derivatives are in other fiat markets, and they're actually bringing them to the cryptocurrency market. Okay, so there's going to be a lot more new products to the cryptocurrency market, which the retail investor, the retail trader or investor, won't be aware of, which will certainly affect the underlying physical cryptocurrency price. Okay, options, which can be puts, calls, and synthetic options. So a put is a sell and a call is a buy. A put option is a sell option, a call option is a buy option, and you can have synthetic options as well, which are derivations of options, options on top of options, okay? Are offered by LedgerX in the US. They allow the holder of the option to buy or sell cryptocurrency at an agreed price on or before a specified date. Now, as you know, with options, they're basically a withering asset. Essentially, as time goes on, the option premium, becomes less and less and less, okay? Options are useful for price discovery when you don't know where prices are. They're not yet widely available through synthetic options where, something can be packaged up exactly to what a client wants. From a bank perspective, the bank can put something together and package it up exactly, but they can be constructed just from futures contracts at the moment. But even then, futures contracts are generally standardized. So there's not an active options market like we see in the equity market or like we see in the foreign exchange market or the bond market. So, with options, if it becomes much more of an active market, it will allow traders to apply established option strategies on cryptocurrency like we see in the foreign currency market and like we see in the equity market and other fiat markets like the bond market. And there are a lot of different types of option strategies that we see in other fiat markets particularly. So if we talk about smart contracts, we know that Ethereum have smart contracts. We know that Tron has smart contracts. We even know Ripple's got smart contracts. But under development on platforms like Codius and Ethereum, automated forward contracts and blockchain, which could also allow either side ownership of a contract. So again, all very interesting. Smart contract derivatives can be used for areas which would be unprofitable for traditional derivatives, i.e. micropayments. Man, that's going to be so interesting. Seriously, that is absolutely fascinating. Smart contract derivatives, man, that just blows my mind. Seriously, I mean, that's combining, blockchain technology with derivatives. I mean, that's just unbelievable. Seriously. Wow, that's gonna be a very interesting financial market product. Seriously, that's absolutely unique, I have to say. So another quiz coming up, product knowledge quiz 2, test your understanding of these new offerings coming to the market. I have to say the smart contract derivatives, that to me is absolutely fascinating. Particularly for micropayments, because traditionally derivative markets are only for the big boys or the big girls. But a smart contract derivative would be a very, very interesting story indeed. So if we go to an overview, basically the anatomy of a CFD, a cash for difference. Okay, a cash for difference basically can have, a value of an underlying crypto. You can basically sell an underlying crypto. It's almost like a derivative or a derivation of the underlying physical crypto. Excuse me. So a cash for difference, you can actually sell the crypto, or you can actually buy the crypto, but you don't actually own the crypto. Okay, so effectively you're taking a position on the underlying crypto. A cash for difference is supposed to mimic the price decline of the underlying crypto or a price rise of the underlying cryptocurrency. So it generally is used for short-term trading or possibly hedging or even copy trading. But again, as we said, it is highly, highly leveraged. If the market moves against you, leverage is a double whammy. Basically, you need margin, and you need basically margin for the product itself, but also money in your account to sustain moves if you get your position wrong. So in other words, if you're short or you've sold the CFD and markets rise, you need money in your account to offset that. Otherwise, you will get closed out by the cash for difference provider, the CFD platform provider. Okay, so again, generally for these sort of products, you've got to be fairly experienced and know what you're talking about and know how to trade these contracts, because they can be quite volatile, and much more volatile, I have to say, than the underlying physical crypto asset. Terminology, ask price. So ask price is generally in the professional market is this pretty much, you've got bid and offer. So when in the professional market, you'll have bid and ask and bid and offer. Okay. And you'll see it that way, but it'll be done by the price maker's perspective. Okay. So it'll be bid ask, bid offer, or buy and sell. Okay. So buy and sell, or bid and ask, or bid and offer, right? And that's done by the price maker's perspective, right? So you as the retail client or as the institutional client, if you're going to buy something, you've got to hit the offer price or the ask price or the sell price. And if you're going to sell something, you've got to hit the buy price or the bid price, okay? So it's actually the opposite. And the spread in between is what the institutional price maker will get for taking on the risk of that position. Okay. So if you lifted an institutional price maker, or you lifted a platform, in other words, you sold or bought, you're either giving someone stock or taking stock out, and you're giving that platform or that person or, that price maker a position. Okay. And the spread is the gap between the buy and sell price. Now, when we've got a cryptocurrency that's very illiquid and barely gets traded, you'll find that spread is very, very wide, okay? And because the spread's so wide, hardly any volume will go through. So it's very important as a trader to be trading. If you're a trader in cryptocurrency markets, it's very important for a trader to be trading cryptocurrency that's liquid with tight spreads. Because otherwise, if you're a trader, it's going to kill you. If you buy something at 38 cents and you can't get out, you can only get out 24 cents, you've already lost yourself 14 cents. And that's just nutty. So you don't trade things that are liquid. Absolutely not. Okay. And also as a trader, you need to be trading liquid markets with volume. You need stop losses in place, and you need to be able to take profits. Now, with a lot of these cryptocurrency platforms, they're very retail, they're not professional. Some of them don't even have stop loss orders in place where you can put stop losses in, and you can't even take profits. Some of the cryptocurrency platforms that I've seen are very bad and not great. Okay, and they really need to get up to scratch, where you can have a take profit target and a stop loss, and even have a guaranteed stop loss. In other markets, you have guaranteed stop losses. Just because you have a stop loss in a market doesn't mean it's going to protect you, because if something doesn't trade at your stop loss level and the market gaps over your stop loss level, you're going to be transacted at where the market price hits, where it sits. And that's the problem. If you have a guaranteed stop loss, you'll get guaranteed at where you put your stop, and you'll pay a premium. But a stop loss will not protect you if the market does not trade there. And I don't think a lot of retail people, clients, understand that. Certainly in FX markets, for example, there are guaranteed stop losses and just stop losses. So there was a situation about 2 years ago where the Swiss franc depegged from the euro. It bounced up about 600 points, which is a lot, 6 big figures. And basically, people that had stops, say 40 points over their sell, got taken out, and their stop got executed at 640 above their existing entry price, because they only had a normal stop in. If you have a guaranteed stop where you pay an extra premium for the stop, you'll get taken out exactly where you want your stop to be, because you paid for a guaranteed stop. Now, the cryptocurrency market doesn't have that, and it needs to become more sophisticated, okay? Because at the moment, it's not very sophisticated in terms of other professional financial markets. If we talk about concepts, again, leverage. leverage, you know, again, with CFDs, cash for difference contracts, because you're using less money than the physical, buying the physical product, you know, buying Bitcoin at, you know, 4,000 US, you know, with CFDs, you can basically get leverage of 5 to 1 or 15 to 1 or 20 to 1 or whatever it might be. So in other words, if you have $100, you can trade with 500. You know, if you go to another provider, they might give you leverage of 10 to 1. You know, if you have 100, you could trade 1,000. But the problem is, if you get it wrong, that getting a transaction wrong and the market's going against you, you're going to eat through your $100 very, very quickly. And that's the problem with CFDs, cash for difference. If you get it wrong, you're going to go through your $100 very, very fast, okay? Also with the CFD, cash for difference, you generally will have a deposit requirement. Obviously, different providers can have different levels. Some can be 20%, some can be 10%, but it just depends. It depends on the provider to who, you know, has what deposit. Now, in fast-moving markets, you can lose more than your deposit that you put in. Now, a lot of CFD providers say you can't. They've got systems that will basically, you know, stop you out. But I can tell you right now, when that Swiss franc depegged from the euro 2 years ago, many people that traded cash for difference contracts lost more than their deposit, because the market moves so fast. Within a second, the CFD platform they were trading on didn't cut them out of the position fast enough, and they actually lost more than their original deposit of $100. Because the Swiss franc had moved up by 600 basis points, or 6 big figures, people that basically had maybe a $200 trading position on lost something like $6,000, and they had to come up with that market. So there was an incredible gap between where the market last traded and where it finished within a second. Now, with cryptocurrency moves, you could basically have big gapping moves as well with breaking news. You could have stop losses moving or take profit orders or anything. But, you know, you need to be aware of all this stuff as the market becomes more and more sophisticated. And every other market, every other fiat market, the markets are much more sophisticated, okay? And in the cryptocurrency market, with the big guys and girls coming in, the professional fund managers, the hedge fund managers, the big people that play with big dollars, the cryptocurrency market on the retail level has to become a lot more sophisticated, because there are dangers. There's no doubt about it. And particularly with crypto derivatives coming in, it's going to change the underlying physical price. Normally in every other market, whether it be the bond market and bill futures and bond futures, whether it be share futures or whether it be index futures against the equity index, the futures market will go first. The price movement will first in the futures market, and then it'll hit the physical underlying market. So you'll get a sell-off in the futures market first, because it's the quickest way to get a position on if you're a trader. You don't go and sell, say, 30 stocks in the Dow. You sell Dow futures. You see what I'm saying? The Dow, the equity market, you don't sell 30 physical stocks, you know, to get your position on. You basically sell Dow futures first, and then, you know, you unwind and start selling the physical. But at least you've got the futures position on when the market's going down, because you don't have time when the market goes down so fast. So the futures market always leads the physical market, always. And it always leads in every other market. And the cryptocurrency market is going to be no different to that, okay? If we look at the origins of things, obviously the first equity swap was developed in London in the 1990s, and it was originally done by institutions and traders to hedge exposure to the stocks and to the London Stock Exchange due to margin requirements and no stamp duty. Later on, it was largely overtaken by spread betting, which is where you buy and sell something. in the UK because there was no capital gains tax on spread betting. Now, spread betting, as I said, is a buy and a sell at the same time. You don't just buy something, you buy and sell something at the same time. It is available in European countries, and what is popular is copy trading. So you get a trader that's very good at what they do, and they basically manage money on behalf of other people, and their trades are also copied. Okay, but not in the exchanges at the moment because they're not registered exchanges. So the pros and cons: access to leveraging, providing you get the position right, it gives you greater potential profit, absolutely. But if you get it wrong, leverage can work against you very quickly, okay? Because if you've got a 5-to-1 leverage, as we said, for cash for difference contract, you've got $100 and you get exposed to $500. If you get it wrong, you're going to eat your deposit up very fast, okay? And again, in this market, the cash for difference market, 60% of retail investors lose money, and it's probably even higher than that. That's the reality of it. Okay, so not good. So then basically, again, it's also high risk, short term. It does require incredible trading discipline. Markets can move very quickly. I trade the US 30 index every night, and that thing can move so fast. You just blink your eye and it can move 100 points. So you just have to be so careful and disciplined and on the ball. Even if you went to go and get a cup of coffee, the thing can turn against you, 100 points just like that. So many people would say, use a practice with a demo account so you understand how it works, get the experience, and do it for a couple of months. And there's nothing like doing that to understand a system. But also, I would even go further than that. I would say practice with a small amount of money, a very small amount of money, and basically get a feeling for what real money is about. Because a demo account, yes, it can tell you how to use the platform, but it doesn't tell you what it's like to trade with real money either. But, you just have to be very, very careful in these markets. Okay, so now we're going to look at practical exercise with going along with the CFD, a cash for difference contract, for a profit and loss scenario. And we've got Alice and Bob, and they think the price of XRP will rise. So they go long, which going long, it means buy. They're going to buy XRP, okay? So Alice has a lower risk appetite and buys 500 XRP at the spot price on a crypto exchange. And Bob is very, very bullish XRP and has a higher risk tolerance, but less money. So it's pretty clear what Bob's going to do, right? He's not going to buy the physical XRP. He's going to buy cash for difference XRP, but he's going to have, leverage, okay? Quite a bit of leverage. So Bob's required margin is 50% in his account, and the broker lends him the additional 50%. Both Bob and Alice have to pay commission on their trades, but Bob must also pay overnight funding costs because he's actually effectively borrowed money from his broker. And on a platform, if you do that on a platform for CFDs, you will have to pay the overnight funding costs, which is basically the interest, okay? Interest, US dollar interest, okay? So we've got this situation where Alice has bought 500 XRP at $1 and it's cost her $5. The closing price after 5 days is $1.50, $1.55. So bid offer spread, $1.50, $1.55. Or bid offer spread, buy, sell, the buy $1.50, the sell $1.55. But this is from the price maker's perspective. So Alice's value is going to be 5,000 by $1.50 equals 7,500. Take off the commission. Her net profit after her $5,000 is 24,675. Okay, and her return is 49.37%. Pretty good return after 5 days. Bob, who's got a higher risk tolerance, basically, the opening price when Bob bought XRP was at $1. Okay, so Bob basically only had to put up $2,500. Okay, but got exposure to 5,000 XRP just like Alice, but he only had to put up $2,500. Okay, he bought at $1 and he's selling at $1.50. Okay, again, he's all up 7,500, but he's only put up 2,500. And this is what a cash for difference can do. You don't need as much cash as Alice, right? So basically, overall, 7,500, commission is less, of 12.50, holding costs, overnight holding interest rate costs for funding that position is that. And so his net profit is 2,461.25. But the thing is, his return is higher because his outlay was only 2,500. Okay, because he used a cash for difference, which is a derivative where you don't need the full funding amount, the full deposit for XRP like Alice needed, because she bought the physical underlying XRP. All Bob got exposure to was the price movement of XRP, but he didn't own XRP, the physical underlying asset, but he did get the price movement. Okay, so if we go to this situation, that was a profit. So if we go to this situation, Alice bought 5,000 XRP. The opening price was $1. So basically it's cost her 5,000. The closing price is 50 cents. So she's basically lost half of her investment and it's gone down to $2,500. Her commission was $18.75. So basically her net loss is 2,518.75. So that the 2,518.75 over 5,000 is basically a net loss or a net negative return of 50.37%. Bob, on the other hand, only used 2,500 to get exposure to XRP's price from $1 down to 50 cents. So he's basically lost 2,500. Okay, less costs. He's basically this is not right actually. Liz, you've made a mistake, darling. This is not right. Sorry guys, because I know. He's basically lost 2,500. Okay, so he's lost all his deposit. Okay, and this is what I'm saying. So this is basically he's lost his whole deposit. So 2,500 minus 2,500, he's lost 100%. This should be 100%. He's lost more than 100% because his costs, he's lost 2,500, okay, which is his loss, because he's lost half. Also, he's lost, add on the 2,500 plus the 750 plus the 875. He's lost 2,500 plus $16. So 2,500 plus the $16. So he's lost 100%. Okay, so it's the same as this, but the opposite, pretty much. So ResourceLink, read about the world's most famous cryptocurrency couple, and this is Alice and Bob. And pretty much that's what we had. Alice and Bob both believed the price will fall, so they'd both be short. And, you know, you can either do it by selling the physical or you can do it by selling the CFD, okay? And pretty much, you know, one gives you one story in terms of return, and another gives you another story in terms of the return. And that's pretty much, you know, what you'd have. Now we'll go into much more detail about this going forward on the course, okay? And then we've got resources there too. So, gosh, these are long, these slides. Wow, what else we got here? So, if you're interested to learn more, I mean, I'm putting all this stuff together anyway. This makes it all nice and beautiful like this because she's the rocket scientist. Please support our Kickstarter campaign and help us make this course. I'll put a link at the description at the YouTube, and you know, it would be lovely if you do support us. It would be so much appreciated, and you know, it'd just be great. And we look happy to producing this course and making it better for everyone, and putting more and more information in. So if you have any you know, any information or any suggested topics, we'd love that, because we'll put that in as well. As I said, it's euro for €45, $50 US, and you know, we think it's going to be great, really, really great. So I'll just better speed this up because there's a lot going on. You know, there's obviously pros of you know, derivatives, and you know, obviously pros and cons of the underlying with the derivative as well. Okay, so we do have a lot here. So better just get through this. But there's key takeaways, terminology, analytical skills, product knowledge, all that sort of thing. But yeah, if you could back the program, that would be fantastic. Absolutely fabulous. You know, please share it. Please share it on social media. It's only got 4 days to go. Thanks for listening, guys, and thanks for watching. And remember, guys, always be kind. Be kind to yourself, particularly. Be kind to your family and friends. You know, your parents, particularly, your family, your friends, your sisters and your brothers. Be kind to your animals, your putty cats, your beautiful dogs, any animal that you have. Just be kind to anyone and everyone, because you know, the world can be a cold, horrible place sometimes. Just make it better for everyone. Life is really, really short, guys. Life goes so quick, and honestly, it goes really fast. So kiss from both Susie and Lizzie.